Ma'am, Parul ko bhi, Terry sir, I think you will have to get Parul also in this thing. She's also in the waiting room. The number of participants have reached, so even Parul is in the waiting room.
हाँ सर, हेलो।
यस सर।
लॉक किया।
संतोष सर आ गए?
हाँ, लेकिन वेटिंग रूम में भी आप दिखाई नहीं दे रहे हो उधर।
नहीं सर, कह रहे हैं मैं हूँ वेटिंग रूम में, सर को फोन किया था।
लेकिन उतने नहीं आ रहा है अंदर, 488 पार्टिसिपेंट्स दिखा रहा है यहाँ पे। ओके। हाँ,
Sir, Parul Singhal also is in the waiting room. Will you take her inside?
यस। Please do not press admit all button. Don't press that. Let Santosh sir join.
हेलो मैडम, आप वेटिंग रूम में हो ना?
हाँ सर, क्या हुआ? हेलो।
अच्छा, आप आ गए। नहीं आया नहीं, आपका फोन नहीं आया।
नहीं है, वैसा नहीं है सर। 459 हटाया मैंने, सबको होल्ड पे रखा है। हाँ, किया हुआ है, वैसा ही किया हुआ है। आप आइए अंदर।
पारू मैडम आ गई है, पारू मैडम से।
हाँ। सबको होल्ड पे रखा है मैंने।
हाँ सर, गिरीश सर कर रहे हैं। आप हाँ कर रहे हैं। मैंने बोला तेरे सर को, वो कर रहे हैं।
नहीं सर, अभी भी नहीं आ रहे हो आप।
सर को फोन किया सर, है वेटिंग में रूम में सर।
नहीं, मैंने सबको बोला है कि मत करो ऐसा। मैंने ओरल इंस्ट्रक्शन भी दिया हुआ है। अभी 449 अंदर है और 51 वेटिंग है। हाँ, आप आप ट्राई करते रहना। आप ट्राई कर, मैंने लॉक किया है। मैं अभी ट्राई करते रहना, मैं 1-2 मेंबर्स निकालता हूँ मीटिंग में से। अच्छा, हाँ हाँ। ठीक है। अभी होना चाहिए सर, आपका होना चाहिए। देखिए, वेटिंग 49 है और अंदर 45 44 ही है। तो आप आ जाइए जल्दी। हाँ, आइए। अभी लेकिन लॉक है, रूम लॉक है। हाँ 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 सर। आइए अंदर। हो गया सर। 60 है
हेलो
वेटिंग। 40, हाँ अभी 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 हो गए वो थे। हाँ, तो जो वेटिंग में है उनको थोड़ी देर के लिए बाहर निकालता हूँ ना, वो वापस आएंगे। वेटिंग में है वो। हाँ, वही तो कर। आप अंदर आइए सर। किया 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 किया, जल्दी आ जाइए, आ जाइए सर।
Yes, Girish sir.
Can we start? It's already 4 o'clock. Let us start. Santosh will join up. Don't worry. Who's comparing the program?
Rupal.
Yes, ma'am. Should I start?
Yeah, you can start.
A very, very good evening and a warm welcome to all. I, Dr. Rupal Shroff, welcome all to Thakur College of Science and Commerce, Department of Investment Banking, to this motivational webinar on finding equity investment opportunities during crisis. A warm welcome to our speaker for the day, Mr. Kunal Ramya. I also welcome all the participant delegates to this enriching session on equity investment opportunity. Before we begin, a little brief about our college. Thakur College of Science and Commerce, conferred with autonomy status last year, is the largest unaided institution in Maharashtra with glorious achievements in the field of academics, sports, research, and other extracurricular activities. We are a relatively young institute established in 1992 and have successfully completed the third cycle of NAC with an A grade. So, it's a matter of great pride for Thakur College as we have been conferred the Best College Award for the academic year 18-19 by University of Mumbai. And as per the Education World magazine of April 2020 issue, we rank 55th in India's top-ranked private autonomous colleges league. We rank 15th in Maharashtra and 13th in Mumbai among the top autonomous colleges as a survey done by the Education World magazine at New Delhi. Tagore College has also been featured as one of the top 10 educational institutions across India in the annual coffee book Edupreneurs by the Times Group for implementing innovative ideas in the field of education. So you see, sir, since innovation and we move together, we come out with a series of webinars on each topic and each subject matter. Sir, we have with us today our principal, Dr. Chaitali ma'am, who will give us a formal address.
Thank you.
Ma'am,
yeah, thank you, Ripal, for your one nice introduction of the college. Good evening to all, and I'm happy to welcome Mr. Kunal Ramya, founder and fund manager, The Streets, and all participants present today at the VR of 4 o'clock. And I can see how enthusiastic everyone is to take up the knowledge, whatever they come their way. So in times when the entire world is going through a difficult, disruptive and dark phase, let us all find a lighthouse full of knowledge, skill and positivity. At Thakur College, we are constantly striving to provide platforms that engage the academic fraternity and enrich their learning. Today's session is one such attempt to bring the best people from the financial sector and enhance our knowledge in this domain, and no one can be better than Mr. Kunal Ramya. Sir, I welcome you on behalf of the management and the institute. From a layman's perspective, financial sector looks most affected, whether it be commercial banks, insurance company, mutual funds, or stock market. All such companies look in a state of flux. Stock markets crashed from 42,000 points to mere 26,000 points, almost fallen down to 50%. We have already seen losses in the financial market of up to rupees 56.22 trillion due to this pandemic. Investor sentiments are low, and it is becoming evident how difficult it is going to be for banks all over the world to maintain good assets and earning. Due to the shutdown and income instability, many repayments of loans may cease, leaving the banks dry. Yesterday's assets becomes today's big risk. If we talk about equity, especially past experiences of epidemics in China and Hong Kong are any clue. Select stocks could be a key beneficiary of the COVID-19 mauling. Several brokerages have already gone overweight on them as they expect this pandemic to bring about a change in the Indian mindset and nudge people to pay more attention to protection against unforeseen threats to life. It will not be harder to live in a denial of life's uncertainty. If projected protection demand to pick up once the dust settles, as valid share inevitably tracks new mind share. Undoubtedly, insurance and protection will be one place where we will see a bloom in business, which in my view is a great step towards pragmatic mindset. Things will never be the same again. COVID 19 will change the way the world works, just like the Great Depression, dot-com bubble, and 2008 financial crash did in the past. I do not want to sound like a pessimist. The road forward looks rough, but I'm sure there are sectors that will benefit and gradually businesses will able to reel in with just a little more wisdom that COVID taught us. And people like Ram, Mr.
Rambia.
Kunal Ramya, who would be giving us a right direction to this uh, COVID-19. And people like him are more wanted in today's time to keep us update and foresee the world. Thank you very much.
Thank you, ma'am. That was indeed actually the mindset today that you've been projecting. We also have with us our IQAC coordinator, Dr. Santosh Singh. Dr. Santosh Singh, can you please say a few words about quality assurances at our college?
Could you get in?
No. No.
No. Santosh sir, are you there?
Anyway, you can just put few words of IQAC because you are in the same department. You can just put it.
Thank you so much, ma'am.
Yeah.
On behalf of IQAC of our college, I take pride in welcoming you, sir, today. I also take a pride in welcoming all the delegates here to sit across and listen to our session on how we're going to do investments in the coming times. IQAC at our college, established in 2005, has always been looking into quality sustenance and has been organizing seminars and guest lectures. And of course, we have been adding new programs on an average each year to ensure that the students are industry met. Quality sustenance, quality assurance has always been the key word at our college, and the entire college under the chairmanship of Principal Ma'am has worked to ensure that we give the best to all our students. That was on behalf of IQAC. Sir, for a brief introduction of you, can I please invite Dr. Parul Singhal, the Dean of Degree Commerce. Parul ma'am, will you please introduce the sir?
Thank you, Rupal ma'am. It is a great pleasure, sir, to introduce you to our eminent participants for the day today. Sir, Mr. Kunal Ramya is a CFA from ICFAI. He's MMS in Finance, a certified financial technician, and a chartered market technician from USA. He's also secured NCFM certificate as an investment advisor, a research analyst for SEBI registrations, and also cleared technical analysis modules for stock market analysis. His rich work experience of last 10 years begins with techno shares and stocks as an associate research analyst to now a proud fund manager of a private fund, The Street. He is a regular speaker on CNBC Bazaar News channel, ET Now News channel, and he's also seen on Bloomberg Quint News channel. He's also a well-known teaching faculty with eminent institutes like Casey College, HR, Hinduja, to name a few. He has also authored and published a book on equity research and technical analysis for BFM students. Sir, your credentials speak a lot about your passion for this particular subject and the webinar on equity investment and technical analysis. We would love to hear from you, and also if you could guide us through these torment times and also give us some guidelines as to how we secure our funds for some kind of security in the future. Over to you, sir. Thank you so much.
Thank you so much, ma'am. It's a wonderful introduction from your side for me. I'll first of all share the screen. Let me know if there are any technicalities or issues so that we can
just
resolve
one
it
second.
immediately.
Can I please request all the delegate participants to keep themselves off the video mode, and there will be question answer session towards the end of the webinar. So over there we could have interactions and questions will be taken up by sir. So that for the smooth functioning of the webinar, if people could just switch off their video modes for the time being. Thank you, everyone.
Yeah,
Over to
Rupal,
you,
ma'am.
sir.
So can we start?
Yes,
Yes,
yes.
sir. Definitely.
Perfect. My screen is very much visible to everyone, and I'm audible.
Yes, very clear, sir.
Perfect.
You can start.
Thank you so much. Thank you so much. So, the topic for the day is equity opportunities during crisis. It sounds a little vague because every time when there are crises in the market and people are suffering, we equity guys always come out in the market and find some opportunities. And that's always been the case, that extreme pessimism leads to markets coming down, and that's the only investment opportunities which we grab generally. Over the period of time, we have seen equities outperforming, and today's session is going to be absolutely on the same. My introduction is already given, so I won't waste much of everybody's time on this. Let's move on to the session. So today I have to make some commitments because there are n number of participants, and that's what we saw, around 500 participants on platform right now, and many more joining on YouTube. So let me just commit few things to all the participants today, that after today's presentation, you all will first understand what common mistakes people make when they come to equity, number one. Number two is I'll be sharing very important and very simple parameters to track and track the market, and to make sure the time when to invest in the market. See, we do have time constraint, and that's gonna be of an hour. So I've kept my presentation to limited things, but out of many parameters which we use, these are the two major parameters which I shortlisted for everyone to make the investments, and at the end prepare all to capture the next upcoming rally in the market. So it has been very clearly said that the time you enter the market, and that's the time when the rally emerges, you can mint the money, and probably you can plan your finances in a much better way. So as we know that we are already in the midst of the crisis and the things around us are not really stable, we need to be ready so that the next rally, whenever it emerges, we are the first guys to capture the same, and at the same time we make tons of money for ourselves, so that we can probably live our excited life as we dreamed of. Okay, just to begin with, what is an investment? Now, of course, I'm addressing to the literate crowd today. So investment basics are known to everyone, but that's the money which we have probably saved. We are using it in such a way to buy instruments in the market so that we can outperform the other instruments. That's how I define the investment. The definition of investment is given by many other authors in their comfortable way. Coming to the next slide, why investment? The main reason behind, theoretical reason behind making an investment is to beat the inflation, and of course to achieve our financial goals that we all have dreamt of some different life. We need to have a dream house, we need to have a dream car, we need to give all luxury to our family, and that's the main reason we always invest. And at the end, we also need to focus on the the happy retirement life which we always thought of when we started probably our career. So that's the main reason why we invest our money. And of course, people are comfortable with different instruments. The way it is highlighted here, people invest in properties, there are people who invest in bonds, people investing in forex, the paintings are also an investment which are upcoming. Hedge funds, mutual funds are the instruments by which they invest in different markets. And of course, the most attractive egg out of all which I found for myself was the equity egg. Of course, the reason behind that is we have seen newspapers and media coming out and shouting crazily when markets are near to the top, and we have that left out feeling in the mind, and that's the reason everyone wants to invest in the market. But the only reason this presentation is made is to make everyone understand when to invest in the market. That's very important. I think my slides are going comfortably smooth. Everyone is able to see all the slides?
Yes, sir.
Yeah, absolutely. Okay. So, coming to the investment world celebrities, we all are aware of these the famous faces of the world. The first is Rakesh Jhunjhunwala, then we have Warren Buffett and Charlie Munger. Every investment advisor in the world will always be quoting Warren Buffett quotes before making any investment recommendations also. We have Damani brothers, we have Radhakrishnan Damani, Ramesh Damani, we have, thousands of people, all celebrities of the world in front of us. So looking at them, we enter the market that yes, this is the kind of wealth which we want to create. Rakesh Jhunjhunwala ji, we all know that he has created more than 10,000 crores of investments. It's a massive amount which he has created over the period of 25, 30 years. And looking at that wealth, we always enter the market. And of course, the main attraction towards market is making big money, right? So that's the main reason we all enter the market. But where are we failing? The most important point is where the retailers fail. We always enter the market when there is chaos all around. We enter the market when the next person who is staying next to my house is minting money on a daily basis. Probably that's the time where the markets are near to the all-time high, and we enter market at that point of time. That's where the retailers get stuck. The greed of making money. That's the main reason where we get stuck. We know that there are gonna be troubles, but yes, the next guy is making around 10-15% a month, and in a year his lifestyle has increased, or he has raised his standard of living to great extent. Keeping that in mind, we enter the market. And at the same time, we ignore the warning signs. There are thousands of warning signs available in market all the time, but we ignore the warning signs and we keep running behind making short-term money. And at the same time, when we are falling off the cliff, we always say that no one actually could predict this. Now, there are gonna be several points which I'll be discussing in today's presentation, which will lead us to a conclusion that yes, there are warning signs, but we tend to ignore the same. And what these celebrities of the world are doing is timing the market, looking at multiple parameters, out of which we are going to discuss two today. Looking at them, we always understand that timing the market is something which is very important. We can't just go to market when the markets are near to the peak and say that, okay, I want to make an investment for next 10 years. You may make the same, but if at all we turn out to be that unfortunate guy who is heading for the massive, who is investing in a market which is heading for probably 2-3 years of correction mode, where the money is coming down by 60-65%, your portfolio is down by 65%, and your money is stuck for probably 3-4 years, you may lose out your patience and you curse the market and you exit. We need to time the market. That's very important. Are we really talking about looking at the market daily and investing in market? Not really. I'm talking about timing the market from investment perspective. The advantage of market is that this market gives us the arbitrage opportunities, trading opportunities, investment opportunities. It's up to us how we want to approach the market. So today's presentation is going to be mainly on creating an investment. And then, of course, we can use that market in a multiple way for us. Now, the problem is we invest in the market looking at the celebrities, but when the crash comes in and when the market starts tumbling, we get depressed, we get nervous, we get disheartened, we exit the market. So we enter the market right at the top. And when the markets are coming down, in that rally of coming down, we exit the market and we think of finding some alternative, which is, probably giving us some kind of mental relief. And that's where we make mistakes, right? So, a few of you must be aware of it. I made a presentation in Thakur College last year where I shared one of my experiences of Maruti IPO. The stock rallied from 125 to 1268 in 2008. From 2004 to 2008, counter went up by 6 to 7 times, 600 to 700% return. But in 2008 prices, that stock was down by 65% in less than a 9 months time. Entire equity market was down by 65%. And of course, my stock was not an exception. So, looking at that fall, anyone can get disheartened or nervous. But when we look at few factors, we can stay on the correct side of market. And that's something which is very important. And the biggest fear and the scare in the mind of people is, what if the market is coming down and I'm stuck on the wrong side of market? At that point of time, the way it is in the present situation, people are talking about fixed deposits being the safest haven. People are saying cash is also a king. I agree to this fact. Yes, but again, fixed deposit is not out of risk. We are forgetting PNC Bank and we are forgetting Yes Bank surprise, which came overnight to us. And we had those 2-3, sleepless nights when the money was stuck for a longer period of time. So yes, any investment which is giving us some kind of returns, there is gonna be risk. But I find still equity to be better off. look at this particular statistic. Now, I'm not actually comparing Apple versus Apple. I'm comparing US market, which is a mother market of all the markets, with Indian market, just on few parameters. Look at the size of equity market. We are just at $2.1 trillion, that's as per April 2020 data. And look at US market, that's at $31 trillion. The market cap of that economy is huge, right? But look at the percentage of population which is investing in equities. In India, it's less than 2%. When it comes to US market, it's 45 to 60% of people are investing in market. Look at the mutual fund penetration. They have mutual fund penetration to the extent of 80%, whereas we are not even at 15%. This is also approximately rounded off to 15%. And that's why till now mutual fund guys are coming out with those banners of mutual fund sahi hai, but they fail to address the client's requirement or probably investors' requirement as to when to invest. They always speak about long term, right? And we are gonna see those points as to why long term is always advisable and when to think of the short term opportunity. How do we come to know? So it's very easy to say now that it was the time to exit the market in 2019-20, and this is the time to now probably enter the market. We need to do some kind of research. Every research is based on the historical performance. So we have Indian equity market history right from 1978. And in 1978, when the Sensex started first operations, and 92 when the NSE started operations and Nifty came into existence. So from there to now, we just go back and check out how the things were before the crisis and how the things turned up during that crisis and what happened after that. So when we look at those things, it will be easier for us to judge something. But before that, we need to do some fact check. Now, what do you mean by fact check? So we have few kind of myths in our mind. I'll share few slides with you in the next coming 5 minutes, where the few myths of our mind may get cleared out, right? The first, we always feel gold is the safe haven. Now again, I call that as a myth. The reason being, look at this chart. Now this chart is pretty interesting chart. It's look at the entire, just one second. Yeah. So look at this entire chart of gold right from 1976, 1975 till now. It is not in Indian currency terms, it's in dollar terms. But look at the performance. Since 1976, assuming it started its operation actually at $100, till now it's somewhere trading at $1,700. And of course, there are crises and the gold seems to be the safest haven. But look at the statistics which I'm trying to highlight on this chart. Right from 1980s till 2006.
वहाँ पे more में click करो, वहाँ पे.
Yeah. So in this entire consolidation, that from 1980s till 2005, the 25 years of consolidation where the prices did not even surpass the high of 1980. So the high was $750. From there, it came down to $250. That's a staggering 66% correction. And markets took 26 years to surpass the previous high. Now that's pretty long pace, right? Coming to recent scenario, that's in 2010, where the gold made a high of around $1,850. From there, the gold is down to by 43%, and that's the beginning of 2016, where it made a low of $1,035. That's staggering 43% correction again, and it's been almost 9 years. The gold has not even surpassed the previous high in international markets. Now, we Indians always feel that gold is safe haven. Of course, we are blessed not to have seen such kind of massive correction, but gold has been laggard. We all know that, right? But yeah, we have a comfort zone that at any point of time, if we have gold, future prices of gold may turn higher. And that's due to inflation or many other factors. But yes, that turned out to be true. But now coming to the next slide, which is this stock market. Is it a risky investment? Again, I call it as a myth. It's not at all risky investment. The next slide will be an eye opener for all of us. It's going to be the entire behavior of Sensex right since inception. Since 1979, where the Sensex started operations at 100 points. Today, this is again April end data. I have not really updated this particular slide. Look at the numbers. It's somewhere at 31,500 to 600. Staggering returns, right? We can't even compare the returns with the gold in this case. But at the same time, I want you to focus on one thing. Number one is, look at the curve in gold chart. It's a curve which is an upward sloping curve. It's not a trend line. It's not a 45-degree trend line the way it is in case of Sensex. Here you can clearly see the rally which is straight going up. every decline in the past is turned out to be a buying opportunity. Now the question comes in the mind is, how do we decide which dip is going to be the last dip, and how do we decide that the bottom is already formed? So for that, I have made few points. So what we do is we take some time from our presentation and we go back and check out how the historical corrections were. So as you know, the principal ma'am rightly highlighted, we had 1992 crisis. That was the time where we depleted our reserves to the greatest extent. We had 2000 crisis, 2008 crisis, 2009 to 13. I call it as a crisis. I'll come to that point. And the last is 2015 crisis. Of course, these are the few crises which I could list. And I'm taking from 1992, reason being, our Indian economy was open for the rest of the world in 92 itself. So there is no point in discussing anything before that. The dynamics have changed, massively after 92. So I have taken the crisis from there. So we go through all the crises and we check out whether there were warning signs available, number one. And number two, how the bottoms were formed. If we are able to answer these two questions using those two simple parameters which I'll be sharing with you, I think more or less our entire presentation will have a great success ratio, right? So we need to check out whether we had warning signs in 2020, number one. If we had and we missed out, it's okay. But are we near to the bottom right now? No. So if those two answers are available, I think our purpose of making this entire presentation or say that platform sharing with everyone is served. These two parameters are first valuation. Now, of course, we know there are multiple valuation ratios available to us. We have PE ratio, we have price to book value, we have price to EV EBITDA ratio, we have multiple ratios like that. I have taken one simple ratio, and that's PE ratio on Nifty front. And the second is price action, as to how the prices behaved before and after the correction. Right. So on these two parameters, let's evaluate all the events. First is 1992 crisis. Now we know that was a fiscal deficit situation. Our reserves depleted to the great extent. We opened the doors for the rest of the world first time. Economy was going to turmoil situation. We borrowed heavy sum of money from other economies. And look at this price action. Now, before we move on to explaining the price action, this every candle, what you can see on the screen, I'm not getting into details of the behavior of candles, but I want you to understand that this particular candle is of every month behavior, which depicts the open, high, low, and close. But look at this bottom of 1991, where the Nifty was trading somewhere in the zone of 300. From there, in 1992 mid, it was trading at 1285. So this return from 300 to almost 1285 turns out to be 300% returns in less than a year. Look at the massive rally which came after that. And immediately after that, we had a correction. Now this correction is highlighted in this percentage form, which is 53% correction from the top. Oof, there was a big correction, right? But that correction never happened in vertical rally. We had a correction of 4 months. After that, there was a 2 months of relief rally. Again, there was a new bottom in the market. Market recovered for 3 more months. It made a bottom again after that for 2 more months. Consolidation phase of around 4 months at the bottom. And then we had a reversal, right? And now, so that's in the price action. So we here realize that the top is formed immediately, but bottom took at least 4 to 5 months consolidation in the same zone before inching higher. Look at the PE valuation at that point of time. Now the PE valuation of Sensex at that time, right from 1990s beginning, was in the zone of 25 to 30. And look at the jump in the PE ratio. Now this PE ratio went up to almost 56, 57. That was a historical high at that point of time. There was a crazy rally which emerged in May 1992. There was a first warning sign. And coming back to the price again, we had made a top at that time itself. And then the correction emerged immediately after that, and the markets were down by 53%. So no, the valuations were pretty expensive. Markets were waiting for one of the events to turn out to be negative. And of course, that negativeness, we all know what was the fact. The markets came down significantly, right? Come to 2000. And again, we try to evaluate the same correction based on these two parameters. So 2000, we know IT bubble crash, and across the world there was a trouble, and the emergence was in US, and the worldwide we had the IT stocks coming down in a massive way. Look at the correction. This correction right from the top again turned out to be 53%, right? But before that correction, the Nifty rallied from 800 mark to 1800 mark. Again, that's 200 and 200 plus percentage kind of returns, right? A massive rally. And immediately we had a correction. But this correction, which came in 2000, lasted for 3 years at the bottom. this red candle which I'm trying to highlight on the screen, from here till here, this green candle where it is coming out of the consolidation zone, this was of almost around 1.5 year correction. This was a time correction. The initial was a price correction. This was a price correction and the time correction. And then markets reversed. Now coming to the valuation, now look at this interesting table. In 1999, you can see the P ratio of Nifty. Now I'm coming back to Nifty because we have all the data available for Nifty right from 92. You can see the valuations were at 12.5 P. So let me just first explain you for those who don't understand P ratio. P ratio means the price earnings ratio, which divides the price with the earnings of the company. So if the ratio goes up significantly, it means either the valuations have the earnings have gone down significantly or the prices have gone up significantly. Now, when we know that the markets are inching higher, if the ratio remains constant, we can say that the price higher, the price which is inching up, is justified by the earnings of the company. But when the ratio shoots up significantly along with the market, it means the prices are significantly higher, but the earnings are not really compiling with the price. So that's an alarming sign. We all can see in 1999, that ratio was somewhere at 12.44. That remained in that range till July 19.5. And look at the December 1999 price earnings ratio. That's at 23. That's alarming sign again. 2000 beginning, that ratio was at 26, 27, which is highlighted in the extreme red color, and we had a correction. Now coming back to the previous slide again, this was the 2000 top where the markets were trading at 26p, and again we had a massive correction after that. You know, that the first warning sign was available on valuation, and of course then there was a reason, there was the IT bubble burst, right? Coming to 2008, the financial crisis, Great Depression, we know Lehman Brothers crashed, and that came as a financial tsunami across the world, and all markets were bleeding. Of course, our market was not an exception, and in 2008 was the time when I burnt my hand first time badly, because I was absolutely new and I never saw the correction in my life. I entered market on this chart. I can say I entered market right at the bottom of 2003, 2004 when the Maruti IPO was coming in, and I read that entire. I would call it this as a honeymoon phase of the Indian market. There was a massive rally, and after that correction, look at the percentage of correction. There was 65% correction right from the top. The Nifty, which was trading in the zone of 6,300, 6,400, came down to 2,300. There was 65% correction from the top. And that correction, again, was into some kind of consolidation right at the bottom for 4 to 5 months. And after that 4-5 months, we inched up, and again, we reclaimed the high in the next year itself. So look at the rally. This rally was of 56 months. And the correction which came was just of 9 months. It just wiped off everything. People say that we stayed invested for a longer period of time, but this 9 months turned out to be very painful. Did we have enough clues to actually exit the market? Come to P valuation again. Look at this percentage of numbers again. 2007, this zone was still in the zone of around 19, 17, 18 kind of zone. Look at the end of 2007. The P ratio went up to 26.5. 2008 beginning, US market actually, mind you, that started correction in November 2007 itself. Our market stopped out in 2008. Of course, probably we were waiting for the Reliance IPO to come up, and Reliance Communication was the last, Reliance Power was the last IPO to come in the market, and market crashed. 2008, we had P ratio of 25, extreme red color. And look at the correction, 65% correction. And when markets were at the bottom of 2008, look at this bottom which was made in 2008 itself in this consolidation zone. Look at the PE ratio. It turned up to 12.5, 13, 13.5, 14 kind of zone. So if I want to label by now as to which PE ratio we should be looking out for investment, I would say 12 to 14 kind of zone is the best investment time, and probably 23, 24, 25 kind of zone seems to be an alarming sign. That's what we have seen in 92, that's what we saw in 2000, and that's what we saw in 2008, right? Coming to the next, that is 2009 to 13. Now, this was a time correction kind of market and lackluster market. There were no events actually. The entire world saw massive correction of 2008. Of course, the central banks across the world pumped in a lot of liquidity, and the markets reversed immediately after that. The reversal was even very faster. And Nifty reclaimed the level from where it fell in just 9 months' time. So someone who got disheartened, probably disturbed, and they exited the position or portfolio in that correction of 2008 must not have entered the market for next 10 years. Reason being, there was almost V-shaped kind of recovery. I would not really call it as V-shaped. There was a consolidation of 4-5 months at the bottom at the same zone, and then we had a recovery. But yeah, it seems like a V-shaped recovery. In 2009 to 13, look at the chart. We reclaimed that high of 2008, and from there till new rally emergence was a lackluster market. Honestly, no openings in equities, because there was a time when I was on job, so I know there were no openings in the market. People are not even talking about something new. We all were waiting for 2014 election to turn up when 2012 and 13 was going on. We were waiting for the BJP super winning, and exactly that's what happened, of course. But look at the price. The market came down by around 28.5%, and this consolidation was very attractive. Look at this P ratio chart, was giving us enough time to accumulate as much as possible, because we were heading for a massive rally. Of course, now we know the future, what happened at that point of time. So it's very easy for us to say, but look at the ratios. The ratios were in the zone of around 22, 23 in 2011 because of extreme V-shaped recovery. And then it was in the zone of 16, 17 again. And when the prices are in that zone for 2 years, markets remaining at the same level, earnings improving bit slowly and steadily, ratio remained at the same level itself. And what we saw after that was a massive rally in 2014, but immediately post Modi rally, there was a massive correction. So we saw a vertical fall, and that vertical fall was again of 26% right from the top. Markets came down by 26%. Look at the rally. The rally was of 18 bars, that is 18 months up rally. And in 10 months, markets made a bottom and it recovered again. This was a kind of V-shaped recovery, because the fall was not really a deep correction like 2008 or probably 2000 correction, where the market came down by 50% and 65%. This was a shallow correction. Look at the P ratio valuation. Because the market shoot up sharply in 2014 itself, 2015 turned out to be extremely valuation, the expensive year, where the P ratio turned out to be like 23, 23.5. And as we have decided the thumb rule that near to 23, 24, we exit our position. Look at this 23, 24. It was extremely expensive in 2015, and the market corrected. And look at 2016. The entire year, it remained in the zone of 21 plus. But there was 1 month, there was February, where the earnings came down to 19.5 kind of zone, right? So valuations turning expensive and markets going very high. These are alarming signs which we need to keep in mind. Coming to the present scenario, of course, we are fighting with invisible enemy, and we know that there is a coronavirus trouble everywhere. The markets across the world are bleeding, and the way Principal Ma'am, highlighted, that's very true, that we don't know how the situation will be going forward. But unfortunately, in this kind of situation itself, equity guys will turn out for shopping. We are sitting at home, we are locked down, but we are finding good investment opportunities which can work probably very well going forward. At least keeping that in mind, again, keeping those two valuation ratios and price action in mind, let's move on to the next slide. Look at this alarming signs of PE ratio. Right from 2018 and till now, that's 2020 beginning, look at the PE ratio. That was in the zone of 27, 28. Extremities were seen till 29 also, which was in 2019, May or June, that's mid of 2019. And 2020 was again 27, 28. We had 2 years time to liquidate the position. And did we see any trouble in 2018-19? Of course, yes. Mid caps started bleeding. Small caps turned out to be micro caps. Extreme fall in those entire segments. When it came to higher valuation kind of stocks, of course, they were not falling. There were troubles around the world. We had US-China trade war. We had Kim Jong-un problem. Every morning when we woke up, we saw the news of, the North Korean guys firing missiles across the world. We had many troubles, but markets were not really falling. Markets were waiting for a massive problem, which turned out to be coronavirus, of course. And look at the fall. In 2020, the vertical fall came in just 3 months time, and markets came down by 40%. And we till now know that there is no stability as of now in the market. The things around the world are bad. We already saw the fiscal stimulus package of 20 lakh crores, so-called 20 lakh crores announced by the government of India, and how the people reacted on it. And we know what are the steps taken by the RBI governor just 2 days back. I mean yesterday itself they announced the SLR policies and different policies. So everyone is trying to stabilize the economy. We don't know to what extent this problem will continue. But now coming to the valuation part, are we really near to the bottom of it, keeping valuations in mind? Honestly speaking, look at this ratio in April, which was at 19.5, is in May somewhere in the zone of 19.5 itself. There is no change in it. The earnings are down, significantly down. In fact, we know lockdown has affected almost all the segments. First time ever in Indian markets that automobile segment declared zero sales in the month of April. Of course, that was in the month of March due to lockdown, and the same situation will continue. So earnings are going down, prices are pretty high. Is that justifiable keeping PE ratio in mind? Not really. So, if I think this answers the question, saying that is it the time to invest in the market? Not really. Let the market come down a bit. And coming to this price action, the first fall which we saw, are we really seeing some kind of consolidation at this zone? Not really. So now coming to the judgment side, which says that if market which made a bottom of 7,500 again reaches back to 7,500, we are right now at around 9,100 kind of zone on Nifty. So if it comes to 7,500, and if it stays there for a couple of months, and if at all earnings visibility improve, I would call this as a bottom. Otherwise, we saw in 2000 also, we saw in 1992 also, and we saw in 2008 also, there was no vertical fall for the entire 9 months. There were 2-3 months of fall. There was a reversal of 1-2 months, again a new bottom, again a reversal of 1-3 months, and then a fall. And finally, the consolidation comes into picture, right? So looking at this price action chart, which is in front of you, can we call this as a final bottom? Not really. So market, number one, if market has to make a bottom here itself, prices have to come down a bit, make a consolidation near to the previously made bottom, which is at say around 7,500. The earnings on PE ratio front, earnings should start improve slowly and steadily, which doesn't really seem as of now. But yeah, keeping 1 or 2 quarters in mind, if at all things turn out to be positive and earnings start improving, and if the prices justify those earnings, we may call this as a bottom. And otherwise, this is a dead cat bounce, and we may fall further. So, the summary of that entire numbers and the charts is, this is the chart which we were referring to. And I just made the slide of it, the parts of it, to keep this as per the years. Look at the 1999. We had correction in 2000. In 99, the ratios were pretty attractive. 2000 beginning turned out to be extreme. Market found out the reason. Market fell down. In 2008, again, beginning of 2008, markets were pretty expensive in terms of earnings. And of course, markets were waiting for the reason. Lehman Brothers turned out to be the reason, and we had a massive correction. Enough shopping opportunity was available in 2013 and 14. And look at the rally after that, which remained open for a couple of years. 2017, 18 tak available tha. And look at the 18, 19, 20. P ratio was pretty expensive. Alarming signs everywhere. But yeah, I mean, the market continued to rally, and that, mind you, that rally which lasted till now was just on 6 counters. In equities, we call it as Ritik effect, which says you have HDFC Bank, you have Bajaj Twins, you have ICICI, you have Kotak, Reliance Industries. Those few counters were rallying. Mid-cap stocks were down, small-cap stocks were down. That divergence cannot sustain for a longer period of time. We are talking about Nifty, and that's why Nifty looked expensive for 3 years. Those 5-6 counters were doing good. Otherwise, there was a pain everywhere. Now coming to the slide like gold, look at the BSE Sensex behavior. We see this entire chart in 2 terms. The number one is, we check out how many corrections we saw in terms of magnitude and how much time it took for the market to recover to the previous high, or say go above the previous high, right? So first crisis was somewhere in the zone of 1980 to 1985. Market came down by around 20%, and to make incremental money, the investor must have to save for 2.5 years. He had to make that much investment. Of course, then we had 1987, 89 crisis again. And in that crisis, the market came down by around 44, 45%. And again, someone who invested right at the top of the market must have taken 3 years to recover that initial investment money and made some incremental money out after that. The longest correction in terms of time, what we saw was between 92 to 2002 correction. Again, I'm ignoring few spikes. I'm not talking about the number one, this particular slide, and the incremental money which was made here. I'm considering this extreme right of this box of 2002. Reason being, I want to justify how much longest time market has taken for investor to make the money. So if someone invested right in the top of 1992, he must have seen the money coming down. So market coming down by 58%. Of course, his money was back to the same level where he invested in less than 2 years. But the incremental profit was made after 10 years of investment. Pretty long time, 60% drainage, and of course, drain of the portfolio, and of course, 10 years of consolidation after that. Coming to 2008 crisis, dot-com bubble, market came down by 65%. Here I've taken 62. I'm ignoring few spikes upside and downside. 62%. And again, I'm consolidating this entire 2008 correction till 2014 correction. And I'm saying that 6 years market took to recover the initial investment and make some incremental money. Actually, initial investment was made available to investors in less than one and a half year itself, but incremental money was made after 6 years. And what we saw post Modi rally was, of course, markets coming down by 26%, and it took around 2 years to make some incremental money out of it. Comparing this with gold, where the money was stuck for 28 years between 1980s to 2008, we are far better off when we stay invested with equities. But of course, now the question comes is, where do we invest? So here we are talking about Sensex and Nifty. We should be talking about only investment in these blue chip companies. Now coming to the present situation. Okay, so look at the present situation. We fell down from the top by 40%. We are already off 28% from the bottom. So I'm just talking about the first correction. What we saw was 2000. There was a 40%. Look at the trend line which is made. Now this trend line is made by connecting all the bottoms of the historical event. We exactly halted somewhere at the same level itself. So if at all markets were to justify this particular trend line, markets will consolidate at this zone for a couple of months or probably a couple of quarters, maybe 6 months or 9 months, valuations getting justified, and then probably rally from here itself. Or we may have a violation of this trend line on the lower side. Markets may come down a bit, consolidate near to the bottom, and then we may see a V-shape kind of recovery. But in any case, if I compare gold investment with equity investment in terms of price correction as well as in terms of time correction, we are far better off compared to that particular asset class, right? So now coming to this slide, which is very interesting slide, we are talking about the worst decision of investment we made in our life till now. Assuming, this is the investment data till April 2020. Assuming I invested right at the top of every crisis and I stay invested till April 2020, what was the situation? Of course, if I look at 1982 or 87, 86, it will always look more attractive. So I'm not talking about the first 3 major events. I'm talking about 2008 crisis. Assuming someone invested right at the top of 2008, right? This guy must have taken almost 3 to 4 years to make some incremental money after that. Assuming he did not liquidate his position in 2020 beginning also, what is the status right now? So if someone invested some sum of money, but in the beginning of 2008, within 12 years, this guy is making still after this correction, which is the lowest point of the recent correction, this guy is making around 23%. I think as per the present data, it must be somewhere in the zone of 30%. So even in this crisis situation, your money is safe, number one. And number two is you're still making 30% in last 12 years. And number three, over the period of time, of course, you must have earned dividend out of it, which turned out to be a tax-free income in a hand, right? So I'm not talking about the first 3 corrections. Even if you have taken wrong decision of staying invested, your investment horizon may increase, but the incremental money which is always made over the longer period of time turns out to be profitable. Now, reason for long-term investment. So number one, we always, till now we have seen the worst case correction, which was of 10 years, right from the beginning of 92 till 2002. Assuming you invest somewhere in the market for long-term period of time, even if the situation turns out to be like 1992, which doesn't really seem to be because now it's more of modern economy, and even that time and this era is very different. Here the government and the central bankers across the world are very proactive compared to that was the time. Anyway, but of course that we need to be prepared for the worst. So if I keep this worst scenario of 1992 in mind, even if you invest right now, the long-term horizon of 10 years, your money will at least be recovered, not like the investment where your money is burst, number one. Number two is You investing in Sensex or Nifty company, you're not breaking your head in finding the best gem of the world, but you are simply going and investing in those leaders of the market. You make decent money out of it. So quality companies and industry leaders. So whenever things turn positive, your company is gonna outperform the same. So if I say Bandhan Bank is gonna do good tomorrow, or say RBL Bank is gonna do good tomorrow, it's gonna be HDFC or Kotak Bank, which will be the leader in the industry anyway, right? Third is dividend income. Over the period of time, when you stay invested, you are at least earning dividend, which will take care of that 2 or 3% as a dividend yield, which is also sufficient many times. And last is, now when we know many things, at least we know PE ratio parameters, which is available free of charge to everyone by just searching on the Google, and the price action, which is available just on the mobile phone. If we make sensible investment based on the discussed parameters right now, our long-term investment can also be labeled like 2 to 3 years of investment. If someone would have asked me to make this presentation in the beginning of 2020, I would not have considered these negative parameters first. I would have spoken something as to be cautious, say for example. But as of now, when the markets are down by 40% from the top, that's the perfect time where we plan our investment. And when the P ratio looks attractive, and of course, if there is a consolidation of 3-4 months, we start deploying our funds. Even if the market reclaims the previous high, because markets are down by 40-50%, and if it reclaims the previous high, in next 2 years, we can simply double our money. It's not a Ponzi scheme where, we are trying to say that 100% returns is possible. It's a logical situation. Markets down by 50%, I don't know whether the bottom will be at 50%, or it will be at 65%, or even it will be lower this time, like 1929 Great Depression, where the market came down by 75%. But yes, these parameters will help us to at least invest, or say start investing near to the bottom of the market. So even market takes it 3-4 years and reclaims the previous high, our money is simply doubled, or say even more than what we invest, more than 100% in that case, right? Trouble of adding stocks. Now the problem is what? The first is the psychological barrier. The problem is when the consolidation comes in picture, we don't know which month is going to be the last consolidating month. It can be 3 months consolidation. It can be 5 or 6 months consolidation. So we are just keeping that range of prices in the mind. And those who understand technical parameters, I would say there is a channel formation, and those who don't understand, it's absolutely fine. Just 3-4 months of high and low of Nifty or Sensex has to be kept in mind. Whenever the 3-4 months high is crossed on the higher side, that's the time we go and start buying, assuming that the markets have made bottom. Now, at that time, if you look at the bottom of the market, you may feel that markets are already up by 3 times, or say 30% or 40%. That's absolutely fine. Still, markets are down by 40% from the top. You're missing out on first 20-30 from the bottom. It's absolutely fine. That psychological barrier is a big problem. Every morning we open the newspaper and they say that markets have reclaimed this level. We have that left out feeling. That's a psychological barrier. We need to overcome that. Number 2 is chaos. The best of the best opportunities across the world are available when the things are bad. And the worst of the worst opportunities are available when the things are very good. So again, Warren Buffett very likely said that, be optimistic when everyone is fearful, and be pessimistic when everyone is comfortable in the market. So, we need to be comfortable when everyone is scared. The day you consecutively find newspapers speaking about market crashing lower and lower, that's the time to go and actually invest in the market. But if you listen to that news and event, remember, markets discount everything well in advance, and that's the next point. Fundamentals may be improving over the period of time, but on the early stage, and that's the reason we may not be able to find the logical reason behind it. But remember, market discounts everything. Market is considered to be the barometer of economy. So economy, if at all, has to do good in future, markets will highlight those things first. Prices will reclaim those things first, because the smart money will start chasing the counters first. And that's why we need to sometimes keep the fundamentals aside. And of course, we need to look at the ratios, valuation ratios, keeping those valuation ratios. Now, people may ask us, when I make presentations, this is my 7th or 8th presentation in this lockdown phase, where I address different crowds. So, people kept asking questions as to how will you label that PE ratio to be justifiable at say 12 or 13. Now, again, look at last 3-4 years ratio. If that ratio is in the zone itself, I would label that as the bottom of the market. How will you justify the market being price making the bottom again? Consolidation of 2-3 months is sufficient for me to call it as a bottom. What we saw right now is markets falling by 40%, markets coming up by 20%. Now that's not bottom. If I were to call that 7,500 on Nifty as a bottom, I would be wanting markets to make consolidation zone before making a new high. It's a vertical shape. It's like throwing a ball from 18th floor. It just goes down and bounces till 4th floor before settling down. So, the bounces should be ignored, but consolidation, a bounce post consolidation has to be considered as the bottom formation. So we need to overcome our psychological barriers, listen to the facts and the figures, and avoid chaos. And remember, fundamentals may not always be supporting markets right at the bottom. They may improve, maybe improving, but we may not be able to find out the reasons behind it. So checklist before approaching the market. Number one is, decide whether you're trading or investing. The biggest problem is this. I visit many colleges, and it's been 8 years in this entire field of teaching again. So when I go and I meet other visiting faculties or other faculties or even students, they say that, sir, actually we want to make money in the market, but the problem is I don't know to stay invested for 6 months. Fair enough. So you are talking about trading. Now show me. So the question comes to me is, give us some stock, or say give us tips where the stock can go up by 20-30%. Guys, be rational. I mean, if we are investing in equities, we are expecting 20-30%, and that should be, of course, without considering risk, cannot happen. So of course, high risk is associated with high return, and high return, I would say, is associated with high risk. You need to keep that risk return ratio in mind all the time. If it's an investment, I need to time the market again. The guy who was sitting on cash right from 2017 must be cursing himself for 18, 19, and 20. That's been 2.5 years rally. He must not be investing a single penny. And in a month's time, market came back to the same level where that guy left the market. So that means market, the guys who have patience win the game in this, the equity market. So we need to remember that investment needs patience. Trading needs different skills altogether. So if you ask me honestly, I'm not really a great trader, but when it comes to investment, I do make good decisions, at least in case of investment. So you need to understand your temperament, your strengths and weakness, and approach the market. Decide the corpus. Second point is decide the corpus. We can't just go and invest the entire sum of money in market. We need to decide the corpus and look at the ratios and look at the parameters. Of course, there are thousands of parameters discussed by the well genius of the market. I'm just sharing 2 with you. So decide the corpus and deploy that corpus, keeping those parameters in mind, and be ready for the worst scenario in the market. When the things are positive around us, we always feel that yes, we will also end up making 20-30% in a month. Of course, there was a year where we doubled our money in less than 9 months time. My entire corpus went up by 220% in 15 months time. There was in 2016 and 17. There was a time. So when the rally emerges, you can make that kind of return, but otherwise we need to be fair in expecting something in terms of returns, right? The next is do your research well. Before making any investment decisions, go back and check out how the market behaved in the past. If it's a gold investment, go and see how the rally was in the past. If it's an equity investment, go and see how the rally was in the past. It's very important to understand the cycle. The guys who bought houses in 1995 to 2005, the prices not really went up. But 2008 to 2018, those 10 years actually turned out to be the property time, where people made probably 5 times and 6 times money by just buying property and selling property. Again, gold at that point of time turned out to be laggard. But last 2 years were fantastic for gold. I would precisely say last 7 months turned out to be very, very attractive for gold. We need to time the market and understand how the things are around us, right? And then make our investment decisions. Expect rational things, of course. If we are comfortable staying invested with fixed deposit at the rate of even 8%, 8.5%, it may just take 12, 15 years to double our money. Why to expect 50, 60% kind of returns when it comes to equity? You cannot expect that kind of returns. Yes, of course you can do that, and there are genius people across the world who are probably multiplying their money by 50% every year. They are increasing their wealth by 50% every year. Jim Simons is one of them. We have many other fantastic guys, but at least for that, we need to have those kind of skills. Otherwise, expect rational things. 15 to 20% returns in regular course of action is always, something which I look out for in the market. Of course, this kind of situation, which is presently, I definitely is aiming to, double my corpus in probably next 2 years, when I feel that the markets are done with the bottom, going extra leverage on the market, keeping risk reward ratio in mind, of course, going extra levered, I may be aiming to increase my corpus 300 times, or maybe, when the markets go double, my money should increase by 400%. So, that's what I'm claiming for, because I know I'm expecting rational things. Markets are at the bottom. You can expect doubling your money. But when markets are stable enough, expecting 15-20% makes sense. So again, all these points we need to focus by looking at the surroundings. And last is avoid chaos and focus on the statistics. That's the only key to, outperform the market going forward. So, again, now onwards, whenever we make any investment factors, we will first look at the valuation, at least relative basis as to where the P ratio is and how it was in the past 5 years, which will give us a fair idea of are we entering the market at the top or at the bottom, number one. And second is price action. A continuously rallying market, absolutely fine. Don't feel that you have missed out the bus. Wait for the correction. And when the correction emerges again, the way we saw the past corrections, these parameters can be kept in mind, and we can approach the market again with these two parameters. And if we follow this regularly, of course, we can have a retirement life throughout our life. Honestly, the capturing the cycle is something which is very important. And if we are able to capture those cycles properly, I think the retirement for, most of the participants is very near by there. Okay, so here I rest my presentation. I hope I justified the same. I do have my contact details. I write blogs regularly. So, this lockdown phase has made me little active on digital media. So these are my contact details. I do share my mobile number and email ID. You have any doubts anytime in future, I'm just a phone call away or a WhatsApp away or say a mail away for you. I do share my views on Twitter regularly. My Twitter handle is Ramya Kunal, and my blog ID is kunalramya.blogspot.com. Ignore the last 3 ones because I'm not really active on that. But yes, Twitter and blog is something where I'm really active. You can always stay connected with me, and I'll be more than happy to answer all your queries now going forward. Okay, so here I end my presentation. Over to you, ma'am.
Thank you so much, sir. It was really very illuminative. There are a few questions which people are waiting for you to answer. Primarily, most of the questions are, what are you expecting post-pandemic? Meaning, do they invest or not? Where should they invest? And very specifically, any mutual fund that you are targeting?
Right. So, that was the entire thesis of our presentation. Should we invest right now? So I think, looking at the parameters, none of the parameters as of now are getting justified to create a new investment. Of course, now when the markets are down, so again, I'm taking that holistic view of last entire 2.5 decades time. The worst case scenario, 10 years, the deepest correction by now, 65%. So if I keep these 2 points in mind, I would say that we are already off, 40% from the top. So that capturing that, investing right at the top, we are not at that level as of now. So somewhere the time horizon of next 10 years may be considered, we can consider that to be like 5 years of investment. And we don't know whether this time we are going to be sub 65% from the top or say 90% from the top. God knows, people are talking about scary things in market right now. But looking at the statistics, I would say that if markets come down by 55% of the time from the top, I would start making an investment. 55%, 65%, and last installment, I'll divide my corpus in 3 parts: 55% first deployment, 65% second deployment, third deployment. Number one, if market goes below 65%, or if market enters into that consolidation phase of say 2-3 months, I'll deploy the last installment. And then probably I'll wait for 2 years time where I am very sure that market will reclaim the high, and at that time I may take off some of my profits off table. And coming to where to invest now, assuming that the guys to whom I'm addressing right now are not really actively into market, I would say simply go and invest in index funds, which are based on the Sensex or Nifty, because we are looking at the Sensex and Nifty data. So if Nifty itself is expected to go up by say 100% from that bottom of 65% down from the top, why should we break our head on making incremental money? If my money simply is, I can visualize that my money is going up by 100% in 2 years, I would simply go and buy index fund at that point of time. I will not cherry pick at that point of time, number one. And the guys who are into market and want to do a bit of research, I would say just go and check out as to in last couple of sessions or say last couple of years, which particular segment or say which particular sector has not done well, and are there any chances of outperformance of that particular sector in the time to come? If you're able to do that kind of research, I would say that, you know, if the market goes up by 100%, your portfolio will go up by 300% in that.
Would you suggest pharma sector again?
Sorry, ma'am?
Would you suggest the pharma sector again?
So, you know, this recently problem of COVID-19 has opened the eyes of many people talking about pharma sector. And what we saw in recent past is the pharma stocks have gone up by almost 30-35% from the bottom. I would like to draw your attention to, you know, first thing that this COVID-19 trouble is not really encouraging me to think of pharma sector, number one. There was a trouble of, you know, US FDA approvals in last couple of years. So I would just come to one example. I would talk about Sun Pharma. So, you know, Sun Pharma in 2004, 5, 6 was somewhere in the zone of around 200 to 250 kind of zone. In 2014, where the BJP got elected and the market started inching higher, there was a time where the Sun Pharma made a high of 1200 rupees. So from 200 to 1200, there was staggering 500% to 600% returns in 5 years time, 6 years time. But since then, it started tumbling. The entire market outperformed till 2020 beginning. This stock came down to 400 rupees. Now, this entire fall was just because of the fact that the US FDA approvals were not easily available for that. And the biggest pharmaceutical market across the world is US market. So keeping that in mind, you know, getting approvals was a bit difficult, but the fundamentals really remain strong. So now, if, you know, of course, the people are looking at the COVID problem and investing in pharma, that is not really the fact. Pharma companies are anyway doing good. Their earnings are really good for last 5 years. The P ratio is at the bottom. So when the P ratio is down, I would look at the reason behind it. So if the earnings are really improving and remaining stable, I expect the sector to outperform in the time to come. But again, this is not an investment recommendation, of course. And the second is that we need to remember one thing, that we are not investing because of this COVID problem. We are investing because the earnings are really looking attractive. So keeping that in mind, yes, one can think of investing, but not from short-term perspective. Again, here I look at the sector from 3 years perspective, and I'm expecting, say, at least on a conservative basis, say 100 to 150% return.
I'd like to invite upon Dr. Manju Singhania to go on to the question answer session. Dr. Manju Singhania, are you there? I think she's not. So I'll continue with it. So any particular mutual fund that you would be talking about, or any SIP that you would recommend?
Right. So, ma'am, when it comes to mutual funds, my work is mainly into hedge funds, and I'm not really actively tracking mutual fund industry. But yeah, I can at least tell you one thing, that you go to any mutual fund, whether it's ICICI or SBI or HDFC or Kotak, or you have Franklin Templeton, all fund managers are the best, guys, number one. But timing the market is something which is very important. So once the markets are down by those levels which we discussed, you simply go and buy any mutual fund. Just contact any of your investment advisors. They can probably give you some statistics. Ignore those statistics, not really required. Simply go and invest at that point of time. Lump sum amount has to be invested, not really SIP, because we are investing right at the bottom. If we do SIP, we end up buying even when the markets are going up. We don't want to do that mistake again. We want to make that bottom as the investment, that zone, so that when the market really goes up significantly, we make decent money out of it. So no SIP when the markets are falling. But yes, this is the time to think of lump sum. That's what I understand in a better term. Of course, I'm a little bit of, risk-taking guy, because that's what I've seen over the period of last 16 years in the market, that when the markets are down, that's the time to be courageous. SIP was the phase of that, 2016, 17, when the markets were rallying up. When the markets are down, think of lump sum investment, and you can make an investment with any fund management house. All are, in fact, brilliant guys who are taking care of the fund.
Sure, sir. Right now, more people are only concerned with safeguarding their money rather than investments. And considering that how savings have helped them survive in the last 2 months, it's just saving and safeguarding their money being most important. With employment issues and job cuts coming up, I'm sure people are only looking at safer investments. So we have with us the IQAC coordinator of Thakur College of Science and Commerce, Dr. Santosh Singh. Sir, can I please invite you to say a few words?
Yes, thank you, Rupal. Good evening, Mr. Kunal, and thank you for your wonderful session. And the topic here, finding equity during the crisis, this is something very close to heart to a common man, all the salary class. And you have given a nice illustration throughout the session. I was listening each and everything. Generally, in this whole discussion, people are very, very conservative. But your illustration for the P ratio and all, it was amazing, let me say. And a normal man can get a fair idea about like what to do about the index fund and all. I am also having a very little knowledge about the, of course, about the equity market and all, and we all do some of the investment. But your illustration here or some of the guideline was really amazing, and I hope here people have enjoyed this particular session, as well as based on your guideline, they will try to make a good money in this crisis, and maybe in a next 2-year time horizon. I hope here each and everyone will have a fruitful outcome, and then at that time they will of course recollect you, and then they will remember this particular session. So thank you so much here for joining here, and I'm also thankful to all the participants, because in this odd time 4 o'clock, I've seen like even the meeting was locked down, and it was very difficult for me to also enter in this. So somehow I managed to enter here, and then I missed my opportunity to interact with you. But of course here most of the participants, there were a lot of interest in for this particular session, and I suppose most of the participants, they have a very good and valuable session for this. So thank you so much for coming here, for joining for this session. Over to you, Rupal ma'am.
Thank you so much.
Rupal ma'am, can you unmute yourself?
Finally, I would like to call upon the coordinator of Investment Management Department, that is Ms. Nisha Bhatnagar. Ma'am, can I please invite you for the formal vote of thanks?
Yes. Good evening to all the dignitaries present for this webinar. I, Nisha Bhatnagar, deem it as great honor and privilege to present the vote of thanks for this event. Firstly, I would like to thank Mr. Kunal Ramya for accepting our invitations and delivering a highly interesting and informative lecture. I would also like to thank the management of Thakur College of Science and Commerce and Principal Dr. C.T. Chakravarti for being our guiding light and source of inspiration for all such endeavors. I would also appreciate the unflinching support provided by Vice Principals Dr. S.D. Ajrekar and Mr. Sachin Kambli, IQAC Coordinator Dr. Santosh Singh, Deans and my teacher colleagues. A special thanks to Mr. Nirav Gowda and Dr. Girish Tere for the valuable contribution to this endeavor. A special word of appreciation for our student volunteers. Lastly, thank you to all the participants from across the country for the encouraging and overwhelming support for this event. Looking forward to your participation in other events too. So thank you all and take care of yourselves and your loved ones. So finally, I would also like to thank all the participations. So please note that feedback form is available in this chat box, and kindly give your valuable feedback and you will get the e-certificate up to 4 or 5 days. Thank you. Thanks.
Thank you so much. Thank you.
Thank you so much, sir. To all the participants, the feedback link has already been put up on the chat. It will be on the WhatsApp group as well, and you will be receiving your certificates shortly. Thank you, everyone.
Thank you so much, ma'am.
Thank you, sir.